Hi friends, myself Subrata Mukherjee and I am working as a teacher in Mahadevananda, Mahavidyalaya, Barrackpore. Today I am going to discuss about bad debt and provision for bad debt. In order to increase the amount of sales, a firm gives credit period to its customer known as debtor. Bad debt is the amount of loss which occurs due to non-payment by debtors. When we calculate net profit for an accounting period, we are supposed to incorporate all the expenses and losses that has helped to generate the revenue or sales, known as matching concept. When we sell goods on credit, the bad debt may not occur in the same accounting period. By making provision, we try to incorporate the estimate amount of bad debt in the same accounting period in which the sale was made. Provision is made as a percentage of debtor based on our experience. On 31st December 2017, B decided to create for the first time a provision for bad debts at 5% on his sundry debtors totaling rupees 5,000. On 1 year later, he decided to continue the provision at 5% on debtors, which then totaled rupees 6,000. If he continued the provision for a further year on sundry debtors, which amounted to rupees 4,000, so by means of ledger accounts, including the profit and loss account, how these three adjustments should have been recorded. Let us discuss what is the structure of the provision for bad debt account and the bad debt account. Bad debt account. Bad debt account is a nominal account. So this is for first year transaction. 2. Debtor account. So when bad debt occurs, journal entry is bad debt account debit to debtors account, and since this is a nominal account, whatever balance will be there in bad debt account will be transferred to PL account. So by PL account. Second year onward. To debtors account as usual. Now in the next year, the amount will not be transferred to PL, rather it will be transferred to provision for bad debt account. So first year bad debt will be transferred to PL account, and second year bad debt and onward will be transferred to provision for bad debt account. Now, what will be the structure of provision for bad debt account? So, first year to balance CD. This will be a percentage on debtor. This amount will be transferred to PL. Now second year onward, by balance BD, this will be the opening balance. Then at the end of the year, to balance CD, to bad debt account, and by PL account. This will be the balancing figure. Provision for bad debt account. Now come to the solution of the first problem. Okay. Now this is the first time the person is creating the provision for bad debt. So on 31st December 2013, to balance CD 5% of 5,000. So this is 250. And on 31st December 2017, you transfer this balance to PL account. This is the balancing figure, 250. Now on 1st January 2018, buy balance BD 250. Now there is no bad debt in this question. Then on 31st December 2018, to balance CD, this is 5% of 6,000, so 300 rupees. And 31st December 2018, by PL, the difference amount will be transferred to PL. Again on 1st January 19, buy balance PD 300 will be brought down. On 31st December 2019, to balance CD, this is 5% of rupees 4,000. So this is 200. And balancing figure will be transferred to PL account. So first year it will be a charge against PL. Next year also it will be a charge against PL. But in the third year this amount will be credited to PL because you require less amount of provision at the end of the year. Second problem. On 1st January 2018, B and Company had the following balances: sundry debtors rupees 60,000 and provision for doubtful debt rupees 3,000. During the year ending 31st December 2018, B and Company sold goods on credit amounting to rupees 15 lakh. This is the amount of credit sales. During the year, customer returned goods valuing rupees 5,000. This is the amount of sales return. While the firm collected in cash rupees 12 lakh. This is the amount that has been paid by the debtor during the year. Allowed discount rupees 2,000 and received acceptances amounting to rupees 2 lakh. This is the amount of bills receivable. The firm could not collect rupees 5,000 from the debtors and had to be written off the amount, to write off the amount. So this is the amount of bad debt. It was decided to maintain the provision for doubtful debt at 5% on debtor as on 31st December 2018. Here I have prepared the sundry debtor account. In the opening balance on 1st January 2018, balance of sundry debtors stood at rupees 60,000. During the year, 15 lakh rupees has been sold to debtors. So journal entry is sundry debtor account debit to sales 15 lakhs. There is a sales return of 5,000. So buy sales return 5,000. Amount paid by debtors rupees 12 lakh. So buy cash or by bank. So journal entry is cash account debit to debtors. Discount allowed to debtors. So buy discount rupees 2,000. BR accepted. So buy BR rupees 2 lakh. Bad debt rupees 5,000. And this is the amount of closing debtor as on 31st December 2018. Now this is the provision for bad debt account. Opening balance, we have a opening balance by balance BD of rupees 3,000. During the year, there was a bad debt of rupees 5,000. So from debtor account, we got rupees 5,000 was the bad debt, and at the end of the year we need a provision. So to balance CD, is 5% on closing data. We have a closing data of 1,48,000. So this is 7,400. And what will be the amount that will be transferred to PL? Rupees 9,400. This is the balancing figure. So 12,400, 12,400. So in this question, bad debt ledger has not been asked to prepare, but we will prepare the bad debt ledger also. So on 31st December 2018, the amount of bad debt will be transferred to by provision for bad debt account 5,000. All of you have been able to understand the concept that I have discussed today. Thank you.